Well, tweets from the president, of course, sent stocks lower at the open today. Donald Trump threatening to increase tariffs on Chinese goods. Investors have been selling stock on fear that those trade talks could be in deep trouble. Alan Nuckman is Chief Market Strategist at Agora Financial. Great to have you with us.
Good afternoon.
We are seeing, of course, stocks moving off the low of the session. A little bit overdone. Do you think an overreaction to those tweets?
Well, that's the good news. We're down, less than 1%. So in the big picture, it's not catastrophic. It was a surprise last night, obviously, but we bounced a good deal off those lows. As a trader, I look at a couple things. The first off was when you gap open sharply higher, sharply lower, where the market goes after the first hour of actual trading. Now, the futures markets obviously were down heavy last night. We never retested those lows. So that could be a healthy sign that a bottom's in. It never went back down, and it never accelerated the downside push. Number two, the second thing I often look at, especially in this Trump economy that we now live in, if you remember back in December or back in the fall, I kind of instituted a two-day rule that you would wait 48 hours after something surprising happened, see how the market sorted it all out and see where we stood. And more times than not, the markets had stabilized and come back. They built in the worst-case scenario, and then they got past it.
We are, of course, aside from the volatility caused by the tweeting president, we are coming up on the tail end of an earnings season that had been a source of worry for some, and it's actually turned out pretty well. Are you revising your outlook based on what you've seen?
No, I've been talking about fundamentals, and this, obviously this, is a little bit of a hiccup today. But if you look at the fundamentals, these are facts. These are things that can't be disputed. It's not opinion. It's facts. If you look at 75% of the S&P companies have already reported, and 75% have beat their expectations by an average of 5%. So as a whole, the growth for this quarter is essentially unchanged, but what we were expecting was negative 5%. So we had a very low low bar to hurdle, and obviously we've done much, much better than that. So corporations are doing extremely well. You get these psychological reactions. Now it's important to see how the markets react here in the next couple of days.
We have seen, of course, the VIX under pressure again, to watching the volatility come back in the market. Where do you come down on something like gold as a role that it can play in a portfolio in times like this?
Well, there's a combination of things to look at. So you saw today when the markets open up obviously sharply lower, the VIX was much higher. Now the VIX has given back a lot of those gains, as we've seen many, many times before. You get a pop-up in the VIX and it gets beaten right back down. So let's see where we stand here, by the end of the day. Also, you talked about gold. Gold's essentially unchanged. Looking at other markets, the treasuries had a little bit of flight to quality, but they've given back some of their gains. And if we want to get into some of the commodities that are directly affected, you look at soybeans. Soybeans are down 10 cents or so off of their lows as well. So you can see how the markets have gotten better as the day's gone on, as we're able to digest this information. But looking at soybeans as a whole, obviously they suffer the most in this China battle. And let me say this as an American. I want people to know that we know that this is a tax. Tariffs are a tax on America. The American consumer pays that added value. We don't get the revenue here in America.
Right.
That China doesn't have to pay that. I'm amazed that people have this confusion that they think that China is sending us a check. No, what's happening is that our goods are having to get more expensive, and the American consumer is paying. So, I don't know whether that's ignorance, but anyways, let's get back to the soybean battle. Soybeans have been trading between 8 and 12 for the last 5 years. 10 was a midpoint. Now we're back down here near the lower end of the range, but there's a combination of factors, but that's been the one sector that's really suffered the most in this, how should we say this, these Trump tariff threats.
Well, of course, we do have genuine trade tensions happening all over the place. How do you to your point of, you want to deal with the facts and fundamentals, we're seeing China taking a sudden hard stand against Canadian canola. Now it seems Canadian pork. We're seeing real anti-trade action being taken. How do you factor that into your thinking about the risk to our economies?
Well, these are not the free markets that I believe in, and so this has really turned everything on its head, and so it's a unique environment that we're in. But I'm still optimistic, and I still remain bullish in the big picture. And to get to the battle with China here in the United States, obviously the talk is about the $500 billion trade deficit that we have in manufacturing, but we also have a $3 300 billion trade surplus when it comes to service. We are a service economy in America. I don't know why people are not aware of that as much, that, this is not the 1960s. We don't make things and sell it to the world. Things have changed, and that's just the current world we live in. Yes, it's a battle, but I think we'll get through it as we have. Obviously, we had a huge rally off that bottom. The markets remain strong. This is not just, it's not the president that makes or breaks markets. It's the profitability of corporations. And if you look at the stock market, companies are doing extremely, extremely well. And we're in a 10-year uptrend.
All right, Alan, great to have your thoughts. Appreciate it.
Thank you.
Alan Nuckman, Chief Market Strategist at Agora Financial.